Hello, I'm John A.G., and what you just witnessed wasn't a normal sell-off, a healthy correction, or a market doing what markets do. It was a floor being pulled out while most people were still standing on it, the kind of move that doesn't just take price lower, but tests confidence, timing, and who actually understands the machinery underneath the chart. Because here's the uncomfortable detail that should make you pause. One of the biggest players involved appeared to close a major position right at the moment the market hit its low. Not close to it, not slightly early, right on it. And when something lines up that cleanly in a chaotic environment, it deserves a closer look. The official explanation, of course, is neat and comforting. A shift in expectations around central bank leadership spooked markets, the dollar moved, metals reacted, end of story. It's simple, repeatable, and easy to package. But simplicity is often where understanding goes to die. Because when you stack the events that occurred around this move, what you see isn't randomness, it's sequencing. Not proof of some cinematic scheme, but enough alignment to raise serious questions about structure, timing, and who benefits when pressure points are hit simultaneously. Before we go any further, let's establish why this matters. If you hold physical silver, paper exposure, mining shares, or even just a portfolio that depends on markets behaving in an orderly way, this move was a preview. A reminder that price doesn't just move on fundamentals, it moves on leverage, rules, and liquidity. And the same move that scares people into dumping positions can quietly hand opportunity to those who understand how forced selling works. So the real question isn't whether silver dropped. The question is whether you were shaken out or whether you understood what was happening as it unfolded. To answer that, we need to talk about one word that almost nobody explains properly, but which determines who survives violent moves like this: margin. Margin is the lever that turns a pullback into a waterfall. It's the mechanism that converts fear into liquidation, and it's central to understanding why this decline unfolded the way it did. So let's rewind and walk through the sequence that made this move stand out. First, reports circulated that a major bank had reduced or closed a significant short position almost exactly at the low. Around the same time, disruptions were reported at a major metals trading venue. Within that same window, an institution tied to that venue reportedly experienced systems issues. And while traders were trying to process all of that, the U.S. Futures Exchange raised margin requirements, forcing leveraged participants to either post more cash immediately or liquidate positions. Then the timing gets more interesting. The sharpest pressure hit when liquidity was thinning, heading into a period when a large portion of global traders were away from screens. That's not speculation. Thin liquidity amplifies moves. It always has. And layered on top of that structural vulnerability came headline risk around central bank leadership, giving commentators a clean narrative hook. A spark landed in dry kindling, and the fire spread fast. Now, I want to be very clear. Pointing out alignment is not the same as claiming certainty. Markets don't need villains to behave brutally. They just need leverage, rules, and timing to line up. And when they do, the people closest to the plumbing often benefit while everyone else argues about headlines. When a market drops this fast, it's tempting to believe the fundamentals collapsed overnight. That demand vanished, that something broke, that silver suddenly became irrelevant. But that's not how real fundamentals behave. Demand doesn't evaporate in a day. Supply doesn't suddenly appear. What does change quickly is positioning, leverage, and the conditions under which people are allowed to hold risk. Here's the core idea you need to internalize. A sharp crash is often less about the asset itself and more about the structure used to trade it. And the first casualties are always the most leveraged participants. That's not ideology, it's arithmetic. In futures markets, most traders aren't paying the full value of the contract. They post an initial margin and are required to maintain a minimum balance. When exchanges raise those requirements, it's like changing the rules mid-game. You can argue fairness later, but in the moment, you either add cash or you sell. There's no third option. Now imagine thousands of traders crowded into the same trade, many operating with maximum leverage, all being told at once to post more money immediately. That's the detail most people miss. A margin hike doesn't just manage risk, it manufactures forced sellers. And forced sellers don't wait for better prices. They hit bids. That selling pushes price lower, triggering more margin calls, forcing more selling, pushing price lower again. This is the cascade. Once it starts, technical levels don't matter. They get overrun. And when you look back at the chart asking where silver failed, you may be blaming the wrong thing. It's not always a failure of the thesis. Sometimes it's a failure of the structure people use to express that thesis. Why would an exchange tighten margins into strength? The benign explanation is volatility management. That happens. But there's a second angle you should always consider. Raising margins at the peak drains the pool. The weakest participants go first. And if you're a large player leaning short, forced liquidation from the long side is exactly the liquidity you want to cover positions efficiently. That's not manipulation. That's how markets function under stress. Here's what the crash did not do. It did not create a single ounce of new silver. It did not erase industrial demand. It did not refill warehouses. It changed the paper price and redistributed exposure. And that's why separating the paper market from the physical market is essential. The paper market is fast, leveraged, and dominated by contracts and claims. The physical market is slower, stubborn, and governed by supply chains, fabrication needs, and real-world delivery. In calm periods, they track closely. In chaotic periods, they diverge sharply. And recent industrial data continues to point in one direction. Silver demand is tied to electrification, infrastructure, data, and manufacturing. It's not just a speculative story. And that matters because price shocks don't eliminate utility demand the way they might for purely financial assets. So when people say this crash solved something, be careful. A paper flush can cool speculation, but it doesn't resolve structural constraints. In some cases, it exposes them. And that's where the next phase of risk begins. Now let's slow this down and deal with the idea of an engineered flush, but without drama or slogans. Do I know who pressed which button, on which desk, at which second? No. And anyone who tells you they do is selling certainty they don't possess. But what I do know is that markets have a long documented history of using rule changes, liquidity shifts, and leverage constraints to reset positioning when trades become crowded. That isn't theory, it's pattern recognition. The pattern usually looks like this. Price rallies hard, participation explodes, leverage builds quietly underneath the excitement, volatility rises, then margins tighten, price breaks sharply, sentiment flips from confidence to disgust. Weak hands swear off the asset entirely. Strong hands accumulate while nobody wants to talk about it anymore. Then later, price begins to recover, often from a structurally healthier base. Different decades, different headlines, same behavior. What you're hearing now from some corners is that this crash fixed the silver problem or proved demand was artificial. That conclusion confuses paper activity with physical reality. A violent paper sell-off can absolutely destroy leverage speculation. It can cool a frenzy, but it does not eliminate structural demand, and it does not suddenly make supply elastic. In fact, flushing paper participation can make physical tightness more visible, not less, because fewer participants are willing to intermediate risk through futures. So who actually benefited from this move? That question matters because it hints at what comes next. The winners in forced liquidation events are usually consistent. Shorts who can buy back lower, market makers who earn spreads during volatility, long-term buyers who were waiting for better prices. The losers are also predictable. Leveraged longs who couldn't meet margin, late entrants using tight stops, and anyone who sold after the cascade had already done most of its damage. If you were using leverage, this move delivered a hard lesson. Leverage magnifies opportunity, but it also magnifies fragility. And when rules change, fragility is exposed immediately. This isn't a moral judgment. Smart traders get caught in cascades because they're trading expected volatility, not regime shifts. Now let's talk about the headline catalyst that everyone latched onto. Expectations around central bank leadership matter because they shape assumptions about policy, inflation tolerance, real rates, and currency strength. A shift toward a more inflation-focused posture implies tighter conditions, a firmer currency, and short-term pressure on dollar-priced commodities. That's the textbook explanation, and it's not wrong. But it's incomplete. These moves are driven by expectation changes, not instant economic transformation. A nomination headline doesn't alter supply chains overnight. It alters positioning around perceived future policy. And when positioning is extreme, even modest shifts can trigger outsized reactions. The headline may have been the spark, but leverage was the fuel, and margin was the accelerant. This is where people usually ask the wrong question. They want to know if the bottom is in. That question turns you into liquidity. Trying to pinpoint exact lows is how traders donate capital to those with patience and scale. The better question is whether the conditions that force selling are exhausting themselves. There are signals for that. Volatility spikes and then compresses. Instruments tied to leverage collapse harder than the underlying asset. Physical premiums remain firm even as paper prices fall. Sentiment flips from enthusiasm to revulsion in days, not months. When those elements cluster, markets are often closer to the end of a flush than the beginning. Now let's add context that often gets ignored. Silver isn't just a monetary metal. It's an industrial input embedded in modern systems. It's used in high-efficiency electrical contacts, brazing alloys, medical applications, photovoltaic manufacturing, and specialized electronics. Even when manufacturers reduce silver per unit, total unit volumes can rise enough to keep overall demand elevated. Grid modernization and electrification aren't smooth trends, but they have direction. And recent order data suggests much of what was once considered optional demand is becoming embedded demand. That creates a baseline of consumption that doesn't vanish just because traders panic. And on the supply side, silver production doesn't respond quickly to price. Much of it is produced as a byproduct of other mining operations. That limits flexibility. Supply cannot surge on command. That mismatch between rigid supply and adaptive demand is why silver experiences periodic stress events rather than smooth adjustments. Now let's deal with two emotional extremes. One camp says this proves markets are hopelessly rigged and participation is pointless. The other says this guarantees an immediate explosive rally. Both narratives feel satisfying. Both can be financially dangerous. The more accurate conclusion is that silver is volatile, structurally important, and heavily financialized. It trades like a currency and a commodity depending on regime. That dual identity is why it explodes when confidence erodes and collapses when leverage becomes one-sided. If you choose to be involved, position sizing and structure matter more than conviction. Markets don't reward stubbornness. They reward adaptability. History reinforces this. In the late 70s, silver entered a blow-off phase before collapsing under rule changes and forced selling. The drama is remembered. The mechanism is forgotten. In the early 2010s, silver surged again post-crisis. Then margins were tightened repeatedly, and price fell sharply. The consensus declared the trade dead. It wasn't. It was reset. In subsequent cycles, smaller versions of the same sequence played out. Different era, same incentives, same human behavior. Here's the uncomfortable but practical takeaway. Paper markets are easier to steer than physical markets. Paper exposure can expand and contract quickly. Physical supply cannot. When physical tightness builds, one way to relieve pressure without letting prices run is to reduce paper demand. Margin accomplishes that efficiently. Does this mean price can't go lower from here? No. Overshoots happen in both directions. If you can't tolerate further downside, that's not weakness, it's self-awareness. But if you're building exposure over time, the question isn't whether you catch the low. It's whether you're participating when fear dominates and long-term drivers remain intact. Those drivers haven't vanished. Silver sits at the intersection of industrial necessity and monetary uncertainty. Industrial demand provides utility. Monetary stress provides narrative force. When both align, volatility increases. Recent policy indecision, combined with persistent infrastructure needs, creates an environment where swings become violent rather than orderly. A forced flush like this can actually improve the quality of future advances, not because pain is desirable, but because leverage has been reduced. Rallies driven by unleveraged demand tend to be more durable than those built on borrowed money. The real danger now isn't what already happened, it's misreading what it meant. If this was a reset rather than a collapse, the next phase may be faster and less forgiving. Recoveries after flushes often occur before confidence returns. People wait for safety. Safety never announces itself. The framework going forward is simple, not easy. Watch physical indicators alongside paper price. Watch whether margins stay elevated. Watch whether open interest collapses and then rebuilds. Watch currency strength and real rates. Watch industrial buyers, not commentators. And above all, avoid being forced. Forced selling is where value transfers hands. Understanding structure doesn't make you clairvoyant. It makes you harder to scare. And in markets like silver, that alone is an edge. Now we arrive at the part most people rush through and then regret later, the what now phase. Because understanding what happened is useful, but understanding how to behave after it is what separates participation from survival. And this is where confusion usually peaks, because price feels like information, when in reality, it's often just a reaction to pressure. Let's start with a simple but uncomfortable truth. The most dangerous moment in a market isn't the crash itself. It's the realization that the crash didn't actually solve the underlying imbalance. When that happens, trust in paper mechanisms begins to erode. And when trust erodes, behavior changes. People stop assuming delivery will be easy. They start testing the system. That's when markets transition from volatility events into structural events. I'm not saying that moment is guaranteed or imminent. I'm saying it's the direction of risk, when paper and physical realities diverge for extended periods. And that's why watching behavior matters more than listening to explanations. One of the first places this shows up is in physical premiums and availability. During paper sell-offs, you'll often see spot prices fall while physical premiums remain stubbornly high. Delivery times stretch. Inventory flows slow. That's not bullish or bearish on its own. It's a signal that the two layers of the market are speaking different languages. When those languages drift too far apart, stress builds. Another place to watch is the structure of futures pricing itself. In calm conditions, near-term and forward prices move in predictable relationships. Under stress, those relationships distort. When immediate delivery becomes more valuable than future delivery, it's a sign of urgency. It doesn't happen every cycle, and it doesn't last forever, but when it appears, it's rarely meaningless. Recent data around manufacturing, energy infrastructure, and electrification projects continues to show resilience that price action alone doesn't capture. Silver demand tied to these sectors isn't speculative, it's contractual. It's embedded in build-outs that don't pause just because traders get nervous. And because silver supply responds slowly, those commitments matter more over time than short-term paper volatility. Now let's talk about positioning yourself mentally, because most damage in markets is self-inflicted after the fact. If you were over-leveraged, the priority is not revenge, it's stabilization. Surviving a drawdown preserves optionality. If you were stopped out and feel angry, recognize that anger is a signal to step back, not step in. Emotional reentry is how small losses become career-ending ones. If you're a long-term participant, the key question is whether your allocation matches your tolerance for volatility. Holding an asset you believe in but can't emotionally or financially withstand is a contradiction. Alignment matters more than conviction. And if you're new, this is the moment to understand the difference between trading exposure and owning an asset. One is about timing, the other is about endurance. Mining equities add another layer of complexity. They are businesses, not metals. They carry operational risk, jurisdictional risk, and financing risk. In panics, they often fall harder than the underlying metal. In recoveries, they can rebound faster. That leverage cuts both ways. Position size is everything. Now let's return to the idea that this move was driven by a single announcement. That explanation underestimates market structure. Leadership expectations can move currencies and rates, but moves of this magnitude typically require more than a headline. They require leverage, thin liquidity, margin pressure, and a crowded trade. Without those ingredients, you get volatility, not cliffs. Here's a simple framework that helps keep things grounded. Headlines are triggers. Structure is the weapon. Leverage is the fuel. Margin is the ignition. Liquidity determines the damage. If you understand that chain, you stop being surprised by violence, and when you stop being surprised, you stop panicking. Silver's behavior relative to gold during this event also fits the pattern. Silver is smaller, thinner, and more leveraged. It moves faster in both directions. Gold is deeper, more institutionally anchored, and less sensitive to industrial cycles. In forced liquidation events, silver almost always absorbs more damage. That doesn't make it inferior, it makes it more sensitive. Sensitivity amplifies both risk and opportunity. Now consider this. If the intent of tightening conditions was to cool excess enthusiasm, it may have succeeded. But cooling enthusiasm doesn't create supply. It doesn't reduce long-term demand. It simply redistributes who holds exposure. And when exposure shifts from weak hands to strong hands, the character of the next move often changes. This is why watching open interest matters. A sharp drop, followed by stabilization, can indicate that forced sellers have exited. A rebuild from lower levels suggests healthier participation. Combine that with margin policy, currency behavior, and physical indicators, and you get a clearer picture than price alone can offer. Silver doesn't move in isolation. It reacts to real rates, currency strength, and liquidity. Falling real rates tend to support metals. Strong currencies tend to pressure them. Liquidity contractions hit everything. The complication is that silver can behave like a risk asset during panics and like a monetary asset during slow burns. Regime transitions are messy. That's when volatility spikes. Now let's address intent versus outcome. Even if no one planned this, similar risk models across large funds can create coordinated-looking behavior. When volatility thresholds are hit, deleveraging happens automatically. The result feels engineered even when it's mechanical. The takeaway doesn't change. If your position only works in calm markets, it's fragile. The deeper risk ahead isn't another sudden drop. It's complacency returning too quickly. When people assume the danger has passed because price stabilizes, leverage creeps back in. That's when the next stress point forms. Sustainable participation requires respecting that cycles don't resolve overnight. Here's the grounded framework to carry forward. If physical markets remain firm, if industrial demand holds, and if monetary policy remains constrained by debt and growth realities, then the long-term rationale for silver exposure doesn't disappear because of one violent week. If those conditions change, plans must change. Flexibility is not weakness, it's competence. Now consider a less dramatic explanation alongside the more cynical ones. Sometimes no one is pulling strings. Sometimes systems behave exactly as designed under stress. Rules trigger responses. Responses feed back into prices. Prices trigger more rules. The outcome is brutal but impersonal. Either way, the lesson is the same. Build positions that survive turbulence. If this was a reset, not a collapse, the next phase may unfold faster than expected. Recoveries after flushes often occur before comfort returns. By the time safety is obvious, price has already moved. That's not a promise. It's an observation drawn from repeated cycles. Watch the next 30 to 90 days closely. Margins, open interest, physical premiums, currency trends, industrial activity. These signals matter more than opinions, and above all, avoid being forced. Forced participants become liquidity. Voluntary participants retain agency. The crash didn't erase silver's role in modern economies. It didn't eliminate electrification needs. It didn't resolve fiscal pressures or debt dynamics. What it did was expose how quickly confidence can be shaken when leverage meets rule changes. If you understand that, you stop being surprised. And when you stop being surprised, you stop making decisions at the worst possible moment. That's the real edge. Not prediction, preparation. Markets will continue to test patience, discipline, and understanding. Silver will continue to behave like silver. Volatile, misunderstood, and strategically important. Whether this move becomes a footnote or a prelude depends less on headlines and more on how participants adapt. And that's where this leaves you. Not with certainty, but with clarity. Not with guarantees, but with a framework. In markets like this, that's as close to an advantage as anyone gets.